On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. Welcome to the On the Tape podcast. I'm Guy Adami, always joined by Dan Nathan, but today we have a treat. Lori Calvasina is with us, head of U.S. equity strategy at RBC Capital Markets. Lori was last here on August 11th, and I will tell you, for those who remember, she was spot on in her assertions and some of her thoughts then, and my sense is she will be again. Later on, Danny Moses and I will sit down talking about a lot of different things. Crazy gold move over the weekend, Sunday night specifically. Crude oil, WTF, that's what people say there?
No, they say WTI.
I see what you did there.
Yeah.
And, of course, Week 14 in the NFL, so stick around for that. Lori, how are you?
I'm great. How are you?
It's great to have you. I mentioned August 11th. Obviously, a lot has happened since then. And, you know, I think you weren't cautious on the market, but you thought some strange things could happen. And everything you talked about back then, because I went back and looked, has sort of come to fruition. Here we are, early December, year end, market's doing well. Just sort of from that point in the summer till now, what sort of sticks out to you?
So, you know, I think seasonality is one thing that's interesting. If you look back at the last 10 years, August, September, October have generally been pretty fraught. November is consistently a good month, and it's, you know, absolutely met with that playbook, and December's more of a toss-up. So I feel like the last few months have made a ton of sense just based on the recent history.
Yeah, and, you know, back in early August at the time, we had just come off a high in the NASDAQ and the S&P 500. There was a lot of enthusiasm, you know, coming into Q2 earnings period at the time, and some of the biggest names, you know, in the Mag 7 were making new all-time highs, Microsoft and Apple and the like here. And it was interesting, though, something happened where a lot of those companies kind of beat and they raised, but they didn't beat and raise by enough. And the stock market started to sell off. A lot of investors were just saying, listen, that made sense. And it did make sense. There was a lot of froth in the market. So, you know, flash forward when you came on August 11th, we're kind of on the tail end of Q2 earnings season. What were some of the things, though? I remember you thinking, you know, I'm not exactly bearish on stocks if I'm thinking out towards the end of the year, but I don't love the setup right here.
Yeah, so we kind of wrote this piece in early August, and, you know, we were trying to emphasize the nuance. And I know everybody likes things to be simple, and sometimes markets aren't simple, and that was just one of those times. And I think the things that bothered us were the seasonality. We'd started to get questions on the election, which seemed like a big air pocket of uncertainty for markets. Our sentiment indicator was looking a little frothy, not crazy frothy, but looking a little stretched. So we felt like between that and the seasonality, you were due for a bit of a pullback. And honestly, the other thing that just bothered me is we got through this reporting season where companies said a whole lot of nothing. And I found investors were really struggling with that. And, you know, we saw the next couple months, really after Labor Day when we were on the road, people kept using the word stuck. They were paralyzed. They didn't really, you know, kind of 2023 was written off at that point. In 2024, it was too early to figure out what to do. What I didn't see was the big surge in interest rates that we ended up having. And I think that's one thing that really stuck a lot of people. But, you know, look, by the time we got to early November, we'd worked the sentiment indicator down, and it was sort of at the exact opposite place of where it was in early August, and interest rate fears, you know, had caused that to happen.
Well, let's talk about interest rates, because I think on August 11th, I think 10-year yields were about 4.05-ish, maybe 4.10. We know what happened. Went up to 5%, seemingly off to the races. Bill Ackman exited his short treasury position, coinciding with some sort of, I guess, softer CPI data, which had yields go from 5% to 4.6% in a heartbeat. And now we're sitting here today, you know, basically round trip the entire thing effectively. Does that mean anything? I mean, I think the bond market is critical. But again, the volatility we're seeing in the bond market suggests, in my opinion, that, you know, we still have some potential equity volatility on the horizon.
I think volatility is a great way to think about it. You know, I do think we're going to have a good year next year. I'm definitely not in the bearish camp. We've still got some very bearish strategists out there, and I'm certainly not in that camp. But, you know, I do think we've got some wood to chop. Our sentiment indicator now on that retreat in yields is back where it was in early August, and that's sort of a negative short-term signal, but, you know, not necessarily a bad longer-term one. What I noticed was really after we kind of kissed that 5% number, I was up in Montreal, and they were putting up the Christmas trees. This was right after Halloween, because they don't have Thanksgiving up there, or their Thanksgiving is earlier, and it was like Christmas. And it was seriously, talking to investors was like talking to kids on Christmas morning. They're like, okay, yields have peaked. What do we buy? And all of a sudden, people were unstuck. And so we were talking about small caps and healthcare and things other than big cap growth. So I think the direction of travel and the path we've gone down, and the fact that even though we kind of are at the same level, we're headed in a different direction, and there's some faith that we can continue down that path, I think that's been constructive despite the fact we feel a little frothy again right now.
Let's talk about that, because this is interesting, a little inside baseball here. Our producers for CNBC, I just sent an email to one of them. They said they want to know for tonight's show, what's the most important chart you're looking at? Okay, so to me, Guy and I were just kind of going back and forth on some different ones. And I've tried to make this case. We've had a lot of great strategists like yourself on the pod over the last, few months, and we've kind of been debating, less so, like you said, about where 2023 ends. Like the cake is baked here. You know what I mean? Really it's figuring out next year a little bit here. But, to me, and I think back to my career, and I started in 1997, and I was at a hedge fund, and I just remember there was a lot of volatility and a lot of different risk assets, you know what I mean? But they weren't as picked over by as many people as there are now, right? There aren't all these podcasts and all this stuff talking about it. So I guess what I just sent, the most important chart to me, and this is just in what I know from being in the business over, let's call it the last, almost 30 years now, is like when the Fed starts raising interest rates, okay, and then they start doing it aggressively to cool things down, right? And then they pause, right? And then people get really excited about the pause. That's what we had over the last couple of months in the equity markets here. It's really when they start cutting that's not good for stocks, right? So if I'm those folk up in Montreal, and I'm excited because the Fed, paused in July, right? And then there was expected to be another rate hike this year. That got pushed out. And now all of a sudden, we're seeing rate cuts being priced into Q1 of next year. So if I just overlay the chart that I just sent to our producer, right, of the S&P over the last, call it 30 years, okay, and then the Fed funds rate on the upper bound, I look at it and I say to myself, I don't want to be buying stocks in the near future here, because when they start cutting, it will not be good for stocks. I mean, does that make any sense? Because from 2000, we got cut in half in the S&P. 2007, we got cut in half when they started cutting in 2020. And again, that was a black swan event, but the S&P sold off 35%. Thoughts on that?
So I think, sort of the history around rate cuts and what it does to stocks, it all depends on kind of your starting point, your time horizon, how many decades you go back. And I can make the case for some near-term volatility around liftoff, or I guess whatever the opposite of liftoff is, drawdown. But I do think that you see things that are hopeful signs. For example, small cap stocks, and that's, I covered those for 7 years back in the day. It's a very, very good sign for small caps and risk assets within the equity market in general when you do get the Fed to start cutting. And what's interesting about that, right, is if you get the small caps working and they've been starting to, have some good momentum again, that suggests there's something bigger going on with rotation. And rotation would pull people out of, kind of the Mag 7 and the big cap growth. But because of the concentration issue, right, do you have sort of a healthy undercurrent, but maybe some damage to the top of the market that you have to work through? And I think it's just a very, very different kind of cutting cycle that we're going to be going through this time.
Give me it's sort of a two-parter here, and we'll sort of dissect it in pieces, because I was going to ask you that. Small caps versus these growth names. I mean, the chasm between the two groups is probably historic. So it resolves itself one of two ways. Those big stocks get whacked, or, these small caps, the Russell sort of catches up. I mean, I know there's a chance that both things happen, but one of two things are going to happen effectively. So I think you believe that this is an environment where small caps can start to catch up to these growth stocks, which have completely outperformed.
Yeah. And look, I think when I look at the big cap growth stocks, I feel like they're starting to lose their advantage on earnings. And that's something that was really distinct at the beginning of the year. A lot of people miss the fact that we basically had an earnings recession in those big cap growth stocks last year. And the first half of the year was defined by recovery. Then value and cyclicals had their earnings recession in the first half of this year, and now they're coming into recovery. So you just don't have these big cap tech stocks as the only game in town from an earnings perspective anymore. And they look crowded and they look expensive. One of the things that's been coming up in my meetings recently is GDP forecast for next year. I find that most people I talk to think if they're not right, and the number next year I think is 1.2% on the consensus, but if they're not right, most people would sort of take the over on that as opposed to the under. And if you start to get a big lift in GDP forecasts, that's going to be good for small caps. It's going to pull people out of some of those big cap growth names.
Okay, so if you're listening to this podcast, it's Friday. Chances are the job numbers come out already. We're doing this on Thursday afternoon for context. But it appears to me as if the unemployment rate is starting to trend the other way, which might be great for the Fed, but I don't necessarily know how good it is because it's coming at a time where there's bank credit seems to be contracting. So when you have an economy predicated on people having jobs and buying things on credit, when credit is going away at the same time jobs are seemingly going away, that's not particularly good, in my opinion, for small cap stocks, small and medium business that employ, 70%, I think, of the population. So I know you have thoughts on that. I'm just curious, what do you think about it?
Yes, I would say small caps, a good rule of thumb is that whatever economic problem is coming around the bend, they price it in way early. And they've been pricing these things in way, way earlier in this particular kind of post-COVID environment that we're in. But if you look back over time, one of the strangest charts I've ever seen in my career, and it took me a long time to make sense of it, but it looks at the small, large relative performance cycle against the unemployment rate. And guess what? When the unemployment rate starts to move up,
they outperform.
That's usually around the inflection, because small caps tend to underperform late cycle when you're heading into a recession. And by the time, my joke is, and maybe, I'm a strategist, I'm not an economist, but I'm as unfunny as an economist.
That's a statement that I use from time to time.
But my joke in meetings is by the time the unemployment rate starts to rise, whatever economic pain is upon us, there's nothing left to fight about. There's nothing left to debate. And by the time you've seen it in that particular stat, small caps have already figured it out. And you tend to want to buy small caps midway through recession. I don't think this is a recession, but whatever this sort of economic pain period is described as, I think it functions the same way for small caps.
Yeah, so okay, this is a great spot to spend a little time on because the small cap index, the Russell 2000, is $2.7 trillion in total market cap. That's 2,000 stocks, people, if you're paying attention at home a little bit.
Is that why they call it that?
Yeah, exactly. So you just figured that out, right?
So wait a second, hold on. So the S&P 500.
500 stocks also. Amazing.
What you learn.
Yeah, it's amazing. All right, so let's just think about that. So that is the market cap of Microsoft. Okay, so when we talk about rotations, right? Like it can only help so much. The Russell is still down 25% from its all-time highs made in late 2021. So we think about that, and I think a lot of what you said about the small caps kind of sniffing it out a little bit when we're going to go into an economic malaise. I could make the argument that, a month ago, the Russell 2000 was trading at levels that it had not traded at since late 2020 and traded horribly, okay? So the fact that we've had this kind of knee-jerk reaction to yields coming in from 5% to 4.1%, it makes sense that the Russell 2000 small caps would outperform. And outperformed that much. They're up about 14% versus an S&P that's up, nearly 12% or so. To me, it might be sniffing out the thing that you think it is. And then I go back to what you're saying, where 1.2% in expected GDP growth for next year after we've had this gangbusters 5% print and everything like that. I say to myself, okay, you have a lot of optimistic portfolio managers who want to kind of take the over here. I say, what could they get wrong? And obviously, from 1.2% consensus, if we were to have a recession, that means 2 consecutive negative quarters of growth, and they could be wrong really easily. You know what I mean? Maybe small caps are actually telling you that they're still down 25% from the 2021 highs, where the S&P is just 200 points, which is just a few percent away.
I think it's fair. And look, my other, kind of joke in quotes in my meetings these days is as a strategist, right? Everyone wants us to have like these 90% conviction calls. And anyone who tells you they have 90% conviction on anything today is lying. I think it's more like a 60, 70% kind of world. And like your calls are kind of more likely than not. And you have to be intellectually honest about that. If I'm wrong and we do really, and we're not late cycle and we are late cycle and we're entering into a bad recession, small caps, we'll look back and say that they were, as you said, sniffing that out.
Would you change your opinion? Let's just say that the small caps, and let's say we get into the new year and some of the money just keeps going into the stuff that's worked, which is what I would expect to happen. Let's say we close here 4,600-ish or something like that or whatever. I think that a lot of the things that people were pretty geeked up about all year long, they're going to continue to be until there's some sort of data point. If we get into late January, into Q4 earnings season, and let's say a Microsoft or something like that just, kind of has a miss and a guide lower or something, then it's over, okay? And you might see relative strength, let's say, in the small caps. But let's just say small caps start acting poorly. Let's say yields firm up to maybe head back towards 4.5% or something like that, and they start going back towards their lows. Is that the thing that might cause you to kind of like take another look at the S&P 500 target of 5,000. Hey, listen, we're not that far away from it. It's 4,600 right now.
Yeah, no, I know. I mean, some people are kind of pegging me as this massive bull, and it's really like not that far off.
7%.
Yeah, but look, I think if the small caps break down, right, what we've seen this market has a remarkable ability to do is rather than when a problem emerges, as opposed to taking the market down, there's sector rotation within. And the sector rotation that would happen would actually be favorable to keeping the S&P afloat, just in terms of putting money back into the things where the market cap is the most concentrated in. So it's a very, very complex set of cross currents right now.
It was pretty clear that sentiment got pretty negative, I don't know, a couple months or so ago as we troughed. I mean, and people will point, it's fascinating to me that people will be very quick to point out how bull bears reverse when the bears are dominating. But when things flip the other way, for whatever reason, it doesn't really make its way out there. Yet as we sit here today, it's complete, the script has been flipped. So now I'm not look, I don't know what's going to happen, but as bearish as people were a couple months ago, that's seemingly how bullish people are now. Does that concern you at all?
It does, and we wrote about that in our weekly this week. So if you go back, I forget the exact date, it may have been like August 7th, but early August, AAII got frothy to the plus one standard deviation mark. Then early November, it was to the minus one standard deviation mark. And we're not quite at the plus one standard deviation mark there, but we're like within, basis points of it. We redid our back test, to be honest, on that indicator and tried to parse out the 3-month return versus the 12-month forward return. And then we also, as opposed to just saying, when you're above one standard deviation, what's the return? What's the return between 1 and 2 and above 2? And that was a really interesting exercise. And it left me with the idea that it's okay to come up and kiss 1. Right? As long as we get out of it pretty quickly and don't go to 2. Doesn't mean we don't have problems over the next 3 months, kind of in the short term. But it shouldn't necessarily, make you crazy bearish over the next year. We've got some problems to work through is what it's telling me. And, does it sort of add to the idea that we might have a weak start to the year? Absolutely. But it is oscillating very, very quickly right now. And we've seen it just move so quickly, even in the last 3-4 months. I think you have to be a little bit careful about making a 12-month bet there right now.
Right. It's because I watch this as well, and it speaks to, you get momentum on the upside over durations. Downside happens very quickly. So this momentum can continue, which you could see a 1 standard deviation go to 1.5 or 2, and seemingly, and you're looking at it like, when is this going to, when's the sell-off going to happen? As opposed to the flip side of the coin where it happens very quickly and then it resolves itself. We might be in for that type of period over the next, few weeks into the next month or so.
Here's my third strategist unfunny joke, but I've complained lately that whatever people think about the year ahead, it always gets baked into the stock market in November and December. And people like me, we put all these forecasts out, and they came out later this year, by the way. Most people came out after Thanksgiving. They should have come out a little bit earlier.
Yeah.
Even I was late, and I came out on the 22nd. But at any rate, it's painful, right? Because you come and you put these forecasts out around Thanksgiving, the market does whatever it does in December, and everyone has to rewrite their reports in January. But it's annoying, right? But there is a rationale for it, which is that in the fourth quarter in December, people are getting set up for the year ahead. And we'll find out over the next month, really, what's consensus, what's overdone, where's people's logic wrong, including mine, by the way. I'm subject to this kind of stuff as well. And then we'll have to, adjust, right, in the first quarter of the new year. So this is a dynamic process.
Yeah, well, listen, we have the benefit. You come on Fast Money quite often. You're out there, you're writing each week and that sort of thing. And there's a level of transparency that I think is really, helpful. I mean, Guy and I, we have the ability to kind of stick to our guns. We're not strategists. We're not your hedge fund manager or, like your broker or anything like that. And we're just kind of calling things the way we see it. And we don't have the data at our disposal that you do. You have these really great quantitative models. You also are out in the field talking to your customers every day, and you have real-time sentiment sort of stuff. So when I think about, as heading into, and Guy just mentioned this, I mean, sentiment late last year was about as bearish as I can remember. Obviously, let's take the COVID period out, in spring of 2020. So we went the other way, right? So, but heading into the year, I don't think many folks had on their bingo card that AI was going to be this thing that just infused so much excitement and enthusiasm in the stock market, which again, all of a sudden people were just throwing out valuation. They didn't care about that anymore, right? And then if you think of the regional banking crisis, when you think about 2024, what are some things that, that could be positive catalysts or negative catalysts that are maybe not on a lot of investors' kind of, the tip of their tongue right now?
No, the biggest thing, right, to surprise markets is always the thing that nobody's thinking about at all. I mean, you even saw that like with Russia-Ukraine a few years back. I think as we go into next year, it's really, I've got things on my mind like the election, right, geopolitics. One thing nobody's talking about recently, and it's certainly not on my bingo card right now, but I think we've seen the street move to the idea that inflation has been killed. I worry a little bit about that coming back. And again, it's maybe 5% risk in my head, right? Like it's not part of my base case. But we've spent a lot of time this year talking about 1945 and how that was the only other time that a recession that's really the only time a recession was never priced into the equity markets. And it was emerging from post-war economy, transition back to normal, removal of government stimulus, healthy underneath the surface, but technical recession, job losses, yada, yada, yada. And what was interesting about that period is if you look at it from an inflationary perspective, inflation cooled that year. I think it was only around 2% or so, but it had been raging prior, and it came raging back in 1946. And the stock market fell. I forget exactly how much. I think it was maybe like 12%. But it was a pretty nasty drop, even though the recession was over and the job losses had stopped and all those healthy undercurrents were still there. Nobody's really talking about deflation either, but I just wonder where that risk of inflation coming back conversation has gone. That's just totally disappeared.
Well, it hasn't gone from the rhetoric out of the Federal Reserve, who, despite the fact that I think we had a conversation with Liz Young earlier, I think 5 rate cuts priced in next year starting in March, if I'm not mistaken, but it's not in the back of any of the rhetoric from, maybe some fringe Fed people, but Jerome Powell has not indicated any pivot whatsoever. So to your point, like that 5% that mine is probably closer to 25, 30. It doesn't make me right, doesn't make you wrong, whatever. But, I still think that this Federal Reserve may be focused on the mid-1940s, clearly on the early 1970s, when I think, again, they probably thought they had slayed that inflation dragon, only to have it come raging back a year or so later.
Yeah, no, I think that's fair. When I talk to my economist and he shows me his CPI heat map, everything's in the green. I just wonder, I really do wonder if maybe we've gotten a false sense of complacency, but I guess we'll see.
Well, that's a good one. I mean, that's something that's on guys' radar, and we'd like to kind of just at least bring those points up because it seems like right now, at least the stock market is discounting. They're focused on a handful of economic, indicators, and they think that, that dragon is slayed for all intents and purposes. When you think about just crude oil, though, like let's talk about this, like a major input, because a lot of folks, a lot of economists, a lot of strategists are always thinking about gas at the pump and what it means for the consumer and the like here. So we've had this move back towards $70 in crude oil. And, I'm looking at like a 5-year chart going back to, the high in 2019 and 20 was $70. And, we really, other than that period in late 2021 and in 2022, when like geopolitical stuff, right? So there was disruption. There's a lot of stuff going on with OPEC. And then we also just had the expectation post-COVID, to your point about what does a post-COVID economy look like. There was a lot of enthusiasm about that. But here we are. We're knocking on the doorstep of 70. And I wonder, talking about deflation, talking about weaker than expected global growth, talking about geopolitical scares, I'm not sure what's priced in right now because, you would have thought after what happened in early October with the terrorist attack in Israel and the war that's come about, I would have thought crude's higher, right? You know what I mean? So help us make some sense of that.
I wish I could. We should get Halima on the phone. Can we call a friend?
No, she was on a couple weeks ago. She was great, actually, by the way.
But I'll tell you that the conversation around oil right now reminds me of conversation about 10-year yields back in the fall before they hit 5%. And I remember there was one Powell press conference. I forget which one it was. And I remember I was listening to it after the fact. I was off that day. So I was listening to it on somebody's podcast. And I just sat there and I said, not even Jay Powell understands why the Treasury yield is moving as much as it is. And I feel that way about oil right now. I will tell you the last, couple weeks, I'm not sensing a lot of panic about it from long-only investors. They're sort of mystified as well on the oil price, but they're starting to look at the valuations of the stock. So we just kind of need the commodity to settle down. What confuses me about it, right, is that we have this moment where the market really seems ready to rotate. And energy benefited from that impulse to rotate over the summer. Now small caps are benefiting from it a little bit. But you would think that energy would benefit from that kind of value-ish type rotation, and it's not. So I think it's a very confusing situation right now.
Do you worry about some of the economic readings we're getting out of China and some of the actions that they're taking? I mean, it seems like they're really trying to support the economy. They're trying to support their markets. It's not doing a whole heck of a lot. The Shanghai Composite's very near 52-week lows. A lot of the actions they're taking almost seems kind of panicky. We know that they're on the cusp of like some major credit issues as it relates to the property sector and the like, and we know how exposed their consumer is. And I just worry that all of a sudden, Guy says this all the time, careful what you wish for. They were dying for 2% inflation as it was kind of working its way up, towards 10. What if we do go, if a deflationary spiral exported from China, would that be positive for risk assets?
I think that the U.S. gets somewhat insulated because you would see a rotation of capital flows into the U.S. And we actually did see over the summer when, people got too optimistic on the Chinese recovery to start the year. When those flows peaked and came out, a lot of it did end up surging into the U.S. and our growth funds in particular. So I do feel like, yes, the word deflation is a very scary one. I don't think that's necessarily good in general for the U.S., but I think we get buffered just because of that safety trade.
A few weeks ago, probably longer than that because time sort of moves very quickly. But, Moody's came out on a Friday and put U.S. credit on their watch list, whatever that means. And I think maybe the market felt it for a day or so. I thought yields would go higher from there, and they really didn't budge. And they're significantly lower since. We've seen them downgrade China. Given our debt to GDP here, it would almost be they wouldn't be doing their jobs unless Moody's and S&P, unless they continue to comment or make some. Is that a concern whatsoever, a potential debt downgrade of the United States?
It's something we obviously keep a close eye on. It feels like with every one of these, the market reaction gets more and more muted. And it feels like, what I think investors are discounting is the idea that they're making these calls kind of late after the horse is already out of the barn. So I wouldn't say people are totally unconcerned, but I think there's a sense of, maybe they're coming out a little bit late, and maybe for good reason, right? So as not to add to the panic. But that's kind of how I see it from a sentiment perspective, that they're letting the market digest the issues first, and then they're making their changes.
And when you think about your 5,000 target in the S&P, and again, we're very near 4,600, we're a few weeks away, barring any sort of, kind of external sort of factor, it seems like the S&P, probably closes plus or minus 2-3% from current levels. What do you think the path to your target of 5,000 is? And again, I know it's really hard, and we just talked about those with certainty and the like here. And I feel like if we were to have a sort of blow off, break out above this year's highs and try to get back towards the January 22 all-time highs, I feel like the higher we go in the near term is the harder we might fall at some point in 2024.
I generally, sort of agree with you in terms of the setup to start the year, but I do, again, I know I keep using the word complex, but with AAII where it is and the fact that next year is a presidential election years usually start off with a sell-off, and then you see the market rally back and kind of get choppy around the election but stabilize and then kind of have the year-end rally. But you do, even with Trump and Biden, right, you saw sell-offs to start the year. So that's got me a little worried that we might come in and see, just a little bit of a downdraft. We're also, I had a question from someone today about Europe and, kind of this idea of the rotation broadening out. So if small caps are doing well, will Europe, which is also part of the value trade, do well? So could you see some rotation early in the year out of the U.S. and into cheaper markets? That could certainly, get you on a difficult path. I want to sort of see, I would say over the next few weeks, how many other people are saying that, because, if we sort of go back and analyze what we did wrong over the past year, one of the things I got wrong was, I fell into the trap a lot of people did that said earnings estimates are too high for 23. They have to come down, and therefore, the market needs to tank. We figured out pretty quickly that was consensus, and then we pivoted, but that's made me a little bit hesitant to sort of pound the table, on sort of a negative start to the year. But that is a risk we see growing.
Something you believe, and this is fascinating for me, the multiple for the S&P 500 is too cheap at these levels. So I don't know. I think we're trading 19 times, again, ish, right? Everything is sort of ish. And, in the way I look at the world, if things are slowing down in what potentially could be a meaningful way, like why would you pay up in terms of multiple for a declining macroeconomic environment? But you think you think a number of different things, but I think the baseline is you think the multiple should be higher. Can you explain that?
Yeah. So look, when I talk to people, if I think back over the past year, right, that's not necessarily the last few weeks, but the last year, you hear a lot of people saying market should be trading at 15 times or 16 times. And recently, maybe that's crept up to 17 or 18, right, because things have been a little bit hotter than anticipated. I've been of the view that we could trade around 20 times or a little bit higher than that, kind of the low 20s-ish. And the reason for that is, and look, I can't speak to the work that other people are doing exactly. I have a hunch based on myself trying to reverse engineer things that people are looking at post-GFC correlations with 10-year Treasury yields. I know people like forward PEs, but if you were to do, I did this exercise maybe like 9 months ago, but at the time we did a correlation between the forward PE, 10-year Treasury yield, and it said based on where the yield was, you should be trading at 16.2 times in the S&P. And I have a different model, right? I'm a student of history. My model goes back to 1962. I only have trailing PE data back that far. So, that's what I got.
Long enough.
Right. But I like the history of it. And I like the fact that it captures an intense inflationary period of the 70s. I'm a strong believer that people who are doing work based on post-GFC period exclusively are not understanding where we are right now. And I don't like to use the term where we are in the cycle. I think that we are the beginning of the pre-COVID era or post-COVID era, and we're trying to figure out what is the right valuation of the market? What is the right level of rates? What's the run rate on GDP? What's the run rate on inflation? We don't know these things yet. We're trying to figure them out. And I think you have to look at relationships over multiple cycles in different kinds of environments. So I like the fact that our valuation model goes back to the 60s, and we basically plug in inflation, we use PCE, Fed funds, we use the effective rate and then the target rate once it's available. We use GDP, which is frankly a garbage indicator. I could take it out of the model, it wouldn't matter. But people like to, put in an assumption. It's easier to do it than to fight with them. And then we also have 10-year yields. And I think that's why the model starts in 62, because that's when the 10-year yield data starts. But at any rate, when we plug all that in and do a 4-variable regression and put in consensus expectations for where all those macro variables are supposed to head, it tells me I should anticipate a 21 times PE at the end of this year and a 23 times PE at the end of next year. Now, if I take those numbers and put them against my earnings numbers, my earnings number for this year is more or less consensus. It tells you to look for 4,700 on the S&P. Guess where we are right now? That's been my most bullish model all year. And for next year, it says we could go as high as 5,300 if my earnings number is right.
Yeah. And it's interesting. We spent a lot of time this time of year last year talking about what is a trough multiple. Like right now we're talking about where markets, are in a bull market where they should be trading, on a multiple basis. But if you took out the top 10 names in the S&P 500, again, Scott, that's, the 490 guy, they were trading at
500.
Yeah, less the top 10, 490.
Less 10.
But there was a lot of analysis. You probably were quoting it too, that there were large swaths of the stock market. They troughed where they should trough at 13, 14 times or something like that. And maybe that's the new normal. You know what I mean? Because you see all of these, the top 10 stocks, this decade versus last decade. I'm fairly certain that 5 of these top 10 at 10 years from now are still going to be the top, in the top 10 or whatever. And maybe that's what changes because, you're just willing to pay a higher multiple for a smaller group of stocks that are just have crazy monopolies. They have huge moats, right? Like just think about it. And they actually have their fingers on what is likely to be the most transformative technology that we've seen in our careers. Does that make some sense?
I think that makes sense. And I'll tell you the other thing I like about my valuation model, and I know I'm talking my book, but it's based on an average trailing PE, and it captures the 70s, right? My old boss at my very first strategist I worked with was Marshall Acuff, and he used to always talk about the Nifty 50. And so we've got a little bit of that baked into the valuation model when you did have, kind of this concentration issue, right? And kind of these stupid valuations in a handful of stocks.
Well,
fascinating.
Well, just to be clear, and while she plays, you are not painting, you're painting a very constructive picture on S&P earnings, on the economy, on what the market should do, on what investors' sentiment should be. Guy and I, I think we have different nuances between our view. I just I'm hard pressed to think that when the Fed starts to cut, it's going to be they're going to be able to put the banner up and say mission accomplished, soft landing, because soft landing is the consensus now, Guy, right? So just talk to us that's how he and I are feeling. We just want to lay that out. We don't want to think our viewers or our listeners, we brought you in here. You sound, it sounds good that you're changing our mind right now, but we're very open to it. Would you say?
100%. And listen, I love your work. It's incredible. And you've been, all the years we've known each other now, I mean, that's one of the people I look to is you. And I respect what you're saying, again, through my lens. And it's important for people to understand, like, I was raised in a Wall Street sort of what can go wrong will go wrong. So I'm clearly the half-empty person all the time. So I'm looking for the next shoe to drop. And maybe it's a function of what happened in 08 and 09 and then the early stages of the show and understanding, you don't want to lead people astray and all those different things. And maybe I'm being too hyperbolic, but it's important for me to sort of put it out there the way I look at the world.
And I think it's important, right? And again, we go back to that 60%, ish kind of conviction level. But I'll tell you, I think a lot about what I've lived through, and we're all the product of our experiences in this business, right? We all have our formative experiences. I started back in 2000, and another joke, but I always say, I was the poli-sci major when they were giving away jobs at the peak of the market in March of 2000, and ended up here. But, I lived through, and I very vividly remember 02, 03. And then I had moved over to a different firm, or I guess I did it shortly after, but I lived through the GFC, and I sort of very vividly remember also 2010, 2011. I think I was on a mountain in the top of Norway, like when the U.S. debt downgrade happened. I was like on this train, like, looking at my CNBC app, riding all the way down, ignoring the beauty around me. But look, I think what's been really helpful to me this year in keeping a cool head and trying to look through a lot of my own concerns has been we have these periods after every major shock, at least the ones I've lived through. We had 02, 03, we had 2010, 2011. You go back to 02, 03, it was messy normalization. We had aftershocks from the prior crisis in terms of WorldCom and Enron, all the regulation on Wall Street that came out, 9/11, and then the lead into the Iraq War. It was a horrible, horrible time. It was full of angst. If you looked at 2010, 2011, it was very similar. And we had the debt downgrade. We had the European sovereign debt crisis. Both periods, we were all constantly afraid of tipping back into another recession at best and major crisis at worst. And I think that's what we're going through. I think we're going through the same thing where we just have a crisis of confidence right now.
Lori, it is great to have you join us again. August 11th last time. If you want to go back to the archives and listen to what she had to say then, I encourage you to do so. We will definitely have you back in 2024. Hopefully it's sort of maybe March-ish so we can look at the first quarter of 2024 and sort of what we're looking for in the second half of the year type of thing. But thank you so much for joining us.
Thanks for having me.
Thanks, Lori.